Hello, everybody. Welcome to our webinar and thank you for attending. Today we're going to talk pretty in depth. We're going to allow some time at the end for questions, but we're going to talk about when wealth is tied to your business, having enough time and the right team really do make a difference. So, in our experience as business brokers, what we see far too often is that business owners don't think about exiting their business quite soon enough. And what that's going to do, it's going to protect and maximize the value of the business that you've really spent years and years building. So, for many owners, the business represents the largest financial asset, and the timing of the transition and the advisors involved can have significant impact on both the options available and the outcome. And some stats that really bring this home are from the Exit Planning Institute, and they found that business owners who are well represented by advisors have an 85% higher success rate in selling their business, and they get 20% more when they have the right team of advisors in place. So if you're a business owner, even thinking about exiting your business in the next 5 years, working with an advisor or a client who's thinking about exiting their business, you're in the right place. So like I said, we're going to go about 45 minutes or so. We'd like to reserve 15 minutes at the end for questions. So you can go ahead and submit your questions throughout the webinar. We'll do our best to get to those at the end. And this session is being recorded, so you'll get a copy back in your inbox once it's complete. So I'm Jeannie Keen. My husband Mike and I have been in the business brokerage and M&A space for about a decade, and we've consulted on the sale of hundreds of privately held businesses. I'm a certified project manager and a licensed therapist, and Mike is retired from the Virginia State Police, where he served as a certified fraud examiner, working with both the U.S. Attorney's Office and the Virginia Attorney General's Office. And we're excited to introduce our guest today. Jaret Mutter is the founder of Valley Wealth Group and a certified exit planning advisor. Jaret works with business owners on the financial and strategic considerations involved in planning for a future business transition, helping owners plan early, strengthening business value, and preparing for the next phase of their financial lives. So thank you, Jaret, for being here today. And our moderator is Rick Chess. Rick is a strategic legal advisor who's led major real estate and business transactions. He advises owners, boards, and family businesses on growth, governance, and leadership transitions, and he served as a founding New York Stock Exchange rate trustee, adjunct instructor, and legislative committee member. Rick also provides guidance on capital markets, 1031 exchanges, and business exit strategy. So now I'm going to turn things over to Rick to walk us through a few questions to better help you understand the importance of planning for an eventual business exit.
Thank you, Jeannie. Today we're going to go back and forth, particularly with Jaret and Mike and Jeannie, and going through some of the considerations that a business owner needs to be thinking about for a future transition. And I would say that every business owner from day one needs to be thinking, because what good is it, winning the battle, losing the war? And so this is kind of looking at what are the basics. So Jeannie, tell us what a business broker does and why you thought it was important to host the seminar.
That's a great question. It's a good starting point because I think a lot of business owners don't really understand what a business broker does, or even that there are business brokers out there who can help represent them through all phases of the sale of their business. So that's exactly what we do. We're hired by the seller to represent them through every phase of selling the business, and that includes roughly 4 areas. So the first area is the valuation of the business, and that's really the jumping off point. That helps business owners understand whether there's a gap between what the business is worth and what the owner needs or expects for their next phase of life. And that's really kind of the first step. That's the first informative piece for business owners to really better understand, is what their business would sell for on the open market. We also help business owners assemble their advisory team, and that may include wealth advisors like Jaret, transaction attorneys, accountants, and often your broker has relationships with other people who are competent and expedient when it comes to business transactions. So your broker will also handle all areas of your confidential marketing strategy, and that includes listing the business on all industry-leading websites, creating the marketing material, and getting that listing confidentially out there for potential buyers to see. We also have a database of thousands of potential buyers that we do send listings out to. Once those buyer leads start coming in, we start screening those buyers, and we're only going to present a seller with buyers who we feel match the criteria that they've told us that it's important to them. We're also only going to present buyers who we feel are ready, willing, and able to purchase the business, because we really want the sellers to stay laser focused on running their business, keeping their foot on the gas. Mean, we all know how hard it is to take the time to list a business or to list, let's say for an opening within the business, to list that employment opening, to start screening potential employees and get them hired. That's a lot of work. So think about trying to do that for someone who's going to purchase your most valuable asset. So once we've identified a buyer, then we begin working on advising on deal structure and closing. That's really the most important work. Like from our perspective, identifying a buyer is kind of the easy part. And then you start getting into the work that really um, doing it incorrectly can have the biggest repercussions. So having a broker doing all of this work for the seller allows them to keep running the business. Like I said, you do not want a dip in sales during this time. You don't want a decline in operational performance. And in a lot of ways, the broker acts as a quarterback for the transaction. We're coordinating all the moving parts to ensure the buyer's communicating with the lender, the attorneys are both aligned, due diligence is managed and stays on track, and the process continues moving toward closing. Brokers also bring experience navigating all of the complexities that can derail a transaction. And believe me, we have seen it all. We've seen lawsuits that emerge the day before closing, and we have lots of stories about how deals feel like they're falling apart. And that's kind of an industry saying that we have. It feels like every deal falls apart 3 times before you can get it to the finish line. And brokers just have a lot of experience, and they have that objectivity to be able to bring all the players back together again. So throughout the process, we're representing and advocating for the seller to ensure that the deal gets across the finish line ultimately.
Well, Mike, I don't know what you were like when you were younger, but there was a time I thought I was God's gift to mankind, certainly to women. But I found out they didn't necessarily see me in the same light. So, can you speak a little bit about how buyers evaluate a business?
Sure. So, Rick, most owners they see it through the lenses of the time that they have invested in building the business, and it's always the rose-colored glasses sometimes. However, buyers they tend to evaluate through the risk and the transferability and also the future earnings of the business. When a buyer comes to the table and it's a private equity group or strategic buyers, they often show up with their own teams of attorneys and analysts and accountants and all the players that are involved. That makes that playing field very complex very quickly. And without having the right advisor on your side to help you navigate that, it can get very, very sticky quickly. One of the reasons we wanted to host this webinar today is because we frequently meet owners who have built remarkable companies, but haven't given much thought at all to the exit process until a circumstance, comes to the forefront. And that could be anything from a seller being burned out or having health issues, or maybe there's a partner in the business that they have a dispute with. All kinds of things can happen that can cause someone to want to, as I say, have a knee-jerk reaction to getting the business on the market and selling it. By the time they reach out, we want to make sure that the financials are lender ready for the most part, because most lenders they want to see clean financials. It doesn't mean that it can't be fixed, but we need to be able to work quickly with the advisors, with the folks that are involved on the seller's team to make that more attractive to the lenders so we can get it across the finish line. You know, owners give themselves a lot of time that surround themselves solely with just working in the business, and they don't think about the financial aspect of it. And when you get those cleaned up, it definitely makes the process go much smoother.
So Jared, talk to us a little bit from a wealth management standpoint, kind of filling into what Mike was just talking about, that the better they are prepared with their own finances, the stronger they are going into the sales process. What changes do you see with this process when you got 2 to 5 years to work it out, as opposed to, hey, it's happening in the next year?
Yeah, so first off, yeah, thanks for having me, guys. I really glad to be here. Passionate about this subject and can't talk about it enough. And working with Mike and Jeannie, I know they are too. So, I mean, the biggest difference is just having flexibility and options, right? Optionality. So, when an owner starts planning 2 to 5 years out, 3 to 5 years out, it creates a window of time that they can take a more strategic approach. I mean, it allows us more time to align the business strategy, the personal financial plan. There's tax planning and estate strategies that often take years to implement and develop before you're at a point where you're exiting. So really, it's focusing on all those things and having the options and doing it in a coordinated way.
I mean, as an attorney, I see things that had the owner thought about what structure they own the business in can make all the difference in the world when you get down to taxes. Go a little deeper with some of your comments about, what you're able to do when you have an earlier window. What specific things might you be able to do for a business owner?
Yeah, I mean, I think initially, the very first thing we need to do is we got to understand how much the owner actually needs from a future sale, to support their lifestyle. So we evaluate the potential, we call that the personal wealth gap scenario. Are we going to have enough from the exit of the business, or maybe even focusing on what do we need, right? What do we want? What do we need? What do we have now? We can help identify what that gap looks like. And then there we at least have a target that we're aiming towards. We can address concentration risk, which is a big deal, and begin thinking about maybe diversifying equity and assets outside of the business, even prior to an exit. And there's lots of different ways we can approach that. Obviously, just coordinating with the CPA team, the attorneys, bringing our folks in as well, looking at those those planning opportunities that need to happen, significantly ahead of the liquidity event. We can structure whether they have outside assets that are currently invested. We can structure them in a way to minimize the additional tax burden that's going to place on them when they do have a liquidity event. And then at the end of the day, we stress test everything. So let's look at the different exit scenarios. What does a third-party sale look like? Internal transition, a recapitalization, is ESOP an option? And then how each of those might impact the plan. But at the end of the day, conversely, when this conversation starts 1 year out, it becomes about execution, not strategy. We're at the point where there's very few planning tools available. Decisions are being made under a time constraint. So I just think at the end of the day, 2 to 5 years out at a minimum, I think planning should begin even sooner than that in a lot of cases. But you're going to have more flexibility, more clarity. Therefore, you're going to have better informed decision. So that's really what it's about.
So Jared focuses on making the owner stronger, more liquid, what have you, and really thinking through the issues. Mike, go over on the business side. We've both been involved in the Association for Business Broker. Owners underestimate the process, how much it takes. Talk about, like Jared did, what things you can do to help them if you just got a little bit more time to kind of work through the things.
Yeah, Rick, most people don't really estimate what the time frame looks like from the day we actually get involved until we actually go to the market and then get to the closing table. Most owners think that this is just one event that's a single event in time, when in reality it's a multi-year project. A couple extra years of preparation can make a huge difference. That might include, tightening up the financial reporting or documenting systems and procedures, reducing the day-to-day independence of the owner being in the business. That's a big one that we see in some of the lower middle market deals where they are the business, and buyers like to see that business run without that owner being there to go to the job site or be the one that's drawing up the blueprints, whatever the case may be. Bring a stronger management team into the business, teach them to kind of run the day-to-day operations, and then let the owner be the one that sets back and runs the business itself. These kinds of things don't happen fast. I mean, it takes time to put managers in place. It takes time to teach them the process that you've built for years and years and years. For example, we've worked with an owner of an HVAC company who initially wanted to sell quickly, but because he was tired and ready to retire, when we reviewed the business, we just realized the financial reporting was inconsistent and a lot of operational knowledge lived only in his head, and it wasn't even on paper in any kind of manuals or anything. So instead of rushing to the market, we spent 18 months tightening up financials and documenting the processes and the procedures and delegating folks within the management team that they could run the business. And when the business ultimately went to the market, buyers could clearly see the company would operate without him, which is huge for the buyer pool, especially in today's market.
So Jeannie, you've had, Jaret talk about how to improve your own financial, situation. You've had Mike talking about improving the business to prepare both for the sale. When you're putting together what kind of advisory team does the owner need to start, putting together? So when you got those two things in place to take the next step.
Yeah, I mean, that's a good question. I think as owners begin preparing for their exit, it's important, like we've said, to surround yourself with that advisory team that can address all the different aspects of the transition, because each advisor does bring a different perspective. So at a minimum, that team should include your business broker who's representing you through the entire process, your wealth advisor who can kind of do that, before after scenario, your CPA, and a transaction attorney. So, like we've said, the broker really helps you focus on positioning the business for sale and then managing the entirety of that transaction process. The wealth advisor helps the owner understand how the proceeds from a sale is going to fit into that broader financial plan. The CPA, of course, helps ensure the financial reporting is clear and understandable to lenders and buyers. And your financials should really kind of tell the story of the business, we say. And then attorneys are going to structure the transaction and address legal considerations. And this is a hugely important role as well. You really want to be sure that you're engaging with a good transaction or business attorney. And hiring the wrong attorney can cost tens of thousands more than is necessary. And we have seen that. You do not want a litigation attorney who's going to litigate the business transaction. And we, as you know, as brokers, we have a pool of good transaction attorneys that we can refer to that sellers can interview. And another reason why time matters is because it gives owners, and we talked about this a little bit earlier, but it gives owners the opportunity to align the business with what buyers are looking for. And buyers tend to evaluate businesses through a fairly consistent lens. And I will tell you, buyers are more educated than they've ever been. I don't know about your social media feed, but mine is every third reel is someone selling a class on how to buy a business, and often it's how to buy a business with no money down, which I can tell you does not happen. But well-educated buyers are looking for things like consistent, well-documented financial performance, reduced dependency on the owner, systems and processes that are transferable, and then the depth of your management team. How much of a role can they take on in running the business in your absence? and then predictable or recurring revenue. So when those elements are present, buyers generally see a business as lower risk, but when they're missing, buyers will often discount the price, lowball an offer, or just walk away entirely. So allowing that extra cushion of time is more about giving the owner enough time to strengthen the business in ways that, and at the end of the day, the market is going to reward.
So Jared is a wealth manager, and you have a broad practice there, but you're also a certified exit planning advisor. What do you typically advise the business owners, and what scenarios tend to put them at a disadvantage?
Yeah. So, I mean, look, every business owner situation is different. They're all very unique. As I mentioned before, I mean, my role typically starts with understanding the full picture. Not just the business itself. As a CEPA, I'm a little different than just an average, typical wealth advisor. We are getting in the weeds a little, and sometimes I think where we shine, it may even be where there is problems or where we do have a gap, and being able to take time. This gets back to having enough of a runway. And this is something that I know Mike and Jeannie can help with too, to say what are some things we can do to kind of help improve the situation. And that's really the benefit of having a CEPA that's focused on value growth, when there are gaps involved in there as well. But we're looking at the personal financial goals, the family priorities. What do we want life to look like after the business, right? So, in our world, in the CEPA world, we talk about three legs to the stool. You have the business, you have the financial, and then you also have the personal. And that's something that I think we don't talk about enough, right? Is what does that really look like? And you've got someone that's devoted their whole life to their business. It's a very personal situation, making sure that they've thought about what life looks like after that. So, will the value of the business actually support what they want as an exit? We spend a lot of time on that on the front end. And then when it does, great. We've got an opportunity for a very successful transaction. When it doesn't, then we need to roll our sleeves up and we got to get to work. But let's do that in a coordinated way, versus in isolation. Back to the point of having that team. Can't stress that enough.
So think about the folks on the call today or listening in the future. Sometimes business owners don't see in the mirror what's really going on, whether it's for their business, their financial. Talk about some specific things that put business owners at a disadvantage, where maybe our watcher can say, "Oh, yeah, that's me."
Yeah, I mean, I think, and unfortunately, this is most of us. I say us. I'm a business owner too, right? But you've got too much of their net worth is tied up in the business, without a coordinated strategy, and we see that all the time. The statistics are, typically you've got more than 90% of your net worth. And how many times have we heard the business owner say, "Oh, my business is my retirement plan." And that's fine, but let's make sure that we've circled the wagons and that we've got a realistic expectation of what that looks like. But when we don't have that coordinated strategy, then obviously we've got limited flexibility. And we don't talk about this enough. It's not, like Mike said earlier, it's not always when you want to go, right? So you got unexpected life events. Let's remember the stats are 50% of exits are not planned. They're not when you wanted them to happen. So let's first de-risk and let's make sure that we protected the value that you currently have. So that's a big disadvantage. And then obviously when there is a gap between what they need and what the business is worth, that can be challenging, but it goes back to when you have the time to work on it and to fix it. Tax inefficiencies, you touched on this earlier, Rick. Whether how you're structured, what your business structure looks like. If you need to change your business structure, if you're a C Corp and you shouldn't be, or an S Corp and you should be, what are some things we can do? If you're looking at doing charitable remainder trusts or estate planning in a broad way, things that takes time that you've got to get in place well in advance. So, just having that clarity, having these conversations, the sooner the better, right?
Talk about this really in my experience with business owners, not only is their net worth tied up in the business, but typically they've had one person, could be a life insurance person. So they're really heavy with life insurance or nothing else. Or one person push mutual funds. So they're really heavy in mutual funds and anything else. Is there a pattern you find that owners are really focused on their financial condition? Or do they end up with concentration not only in their business, but in how they've taken their other monies?
Yeah, no, you're absolutely right. I mean, quite often, they either have one advisor or their advisor maybe is a little siloed or a little too focused in one area and doesn't have doesn't understand all aspects. And so I strongly encourage, everybody on the call, make sure that you have a diverse team in place. Not only everyone that Jeannie mentioned earlier, but your wealth team should have a CEPA involved, should have someone that understands insurance as a way of protecting and making and maybe helping alleviate some of that concentration risk in the event of that unplanned exit. Someone that understands taxes and how they impact and what are some things we can do now. There's a lot of great firms out there that like ours that has members of their team that can kind of focus. I would make sure that you're working with advisors that work with business owners, not as a ancillary part of their business, but as a core, because we really are a different breed. With challenges, both wonderful things and challenges that come along with it. But yeah, I mean, it really is important to change how you're looking, I think, as an owner, about not waiting until the end to try to create some diversification. That needs to happen along the way. Really does.
So Mike, let's build off of what Jared talked about on taxes, because they're clearly things that owners do in the short term to solve what they perceive as a tax problem. And they have this massive issue coming down, some of which might, for instance, could be handled with insurance, could be handled other ways. But what kind of, short-term strategies create challenges that as the business broker, you're helping them try to sort out?
Rick, that's one of the most common challenges we see. Really, when we say get your financials in order, that means get your financials in order, because that takes the longest of the whole process. Many business owners understandably focus on minimizing their taxes year to year. They may have gotten advice from their CPA that may recommend writing off equipment or, accelerating expenses at the end of the year, making those purchases, fall in line with the cost of goods or wherever they may be hidden in the tax returns. They make sense from a tax perspective, but when it comes time to sell the business, lenders and buyers especially, they evaluate the profitability, not just what the revenue is. What I would strongly suggest at that point, if you're considering on selling, make sure you have these conversations early with your accountant. Make sure, unfortunately, people don't like to pay taxes no more than they want to, put the money in their own pocket. They want that there. However, pay the taxes on it. You can cheat the government once, but you're not going to cheat them twice. And I can tell you the banks, they see right through this. A little bit of tax money for the next couple of years may get you another 20 or 30% on the value of the business when you go to market and sell it. If you don't do that, it's going to lower the valuation for sure. And it's definitely going to reduce the financing options that we have. I mean, especially with the new rule changes we have today with the SBA, it's really hard to get these things across the table. For example, I've worked with a business owner whose company was really strong in revenue, but the tax returns showed a very minimal profit on the bottom line, and they were aggressively writing off equipment. I've had one that they spent over $100,000 and putting a swimming pool in their backyard. They've had a roof split on their house. I mean, I've had a little bit of everything come through the front door. You can tell the bank all day long that, hey, these expenses are not legitimate business expenses, but the bank's not going to see it that way, and nor is the SBA. And I can assure you that we're not going to convince a buyer to pay you an extra $100,000 or $150,000 for the swimming pool you put in your backyard.
Well, Jared, moving on from staff meetings at the swimming pool, which hopefully also got written Uh, give us some example of like how, as a wealth advisor, you align with what Mike's doing on the transaction side.
Yeah. So Mike, the hot tub in the break room, not a good idea, I'm guessing.
Yeah.
Yeah,
Yeah.
no.
Yeah, I hear you. I bet you've seen it all. Yeah. I mean, look, it's a really important distinction. You know, we talked about working together and having a team. Coordination matters. You know, a business broker or an investment banker, you know, they're primarily focusing on the transaction itself, primarily. I think Jeannie and Mike go a little above and beyond that, your average business broker, but yeah, they're identifying buyers, negotiating the terms. They're basically, you know, the CEO of the transaction, right? But they're focused on maximizing the value and successfully getting the transaction done. My role is complementary, but it's a little bit different. You know, I'm focused on how the transaction fits into the owner's broader financial life. And so again, how much liquidity we need to support the long-term goals, modeling that after tax, like we've talked about, just from a potential transaction, you know, planning for that diversification and investment strategy after the sale, right? These are the things that we're focused on more so. So the broker's focused on getting the deal done. I think I'm focused on more about what does the deal really mean, you know, for my client and the family.
So we've talked about the why. We've talked a little bit about the what. Talk to us a little about when. You know, when do you need to step in? I mean, I know as early as possible, but you know, talk about the when because, like, you know, just kind of go with that.
Yeah. Yeah. I mean, listen, this is just like beating a dead horse, but you can't start soon enough. I think I've heard Jeannie say in the past that just, you know, start when you start the business. I mean, you know, managing the business and understanding building value, you know, over time, I think is a great approach. You know, to Mike's point, yeah, maybe you can do some tax planning early on, but understanding the impact that's going to have, you know, on your business valuation if you do need to exit. So I just think that the conversations, I mean, at a minimum, they need to begin well before the business goes to market or before you're thinking about taking it to market. We got to think through things like, you know, how much do you need? What do taxes look like? What are some tax law changes? You know, are cap gains going to be different in 5 years and 10 years versus today? Obviously, how the proceeds are managed. And then, you know, something that we don't talk a lot about is what if there is a gap, right? What if you thought your business was worth a lot more? You might be 5 years out, but it could take a long time to get things where they need to be. That's a heartbreaking situation to be involved in when you're us and knowing that, God, if we'd have just been involved, you know, 3 years ago, 5 years ago, what we could have done. What can we do to close the gap? You know, what can we do to get in the weeds and find ways to ultimately increase the value? So we can start to visit what, you know, the value growth methodology looks like, which is a CEPA that we're kind of trained to look for those kind of low hanging fruit and ways that you can immediately improve the value, and then some things you can implement over time that are going to make a big difference and hopefully close the gap.
So Jeannie, give us an example that kind of shows us the difference between early planning and late planning. What does it mean in a practical sense?
Yeah. So, you know, one thing that we remind owners is that, and this is important, that buyers don't purchase businesses based on the history of the business or how much effort you've put into the business. They purchase businesses based on risk and future earnings potential. So the more predictable and transferable the business appears to be, the more valuable it becomes in the eyes of the market. So that's really where preparation makes a difference. And, you know, like we've said, too often we meet sellers who haven't really thought about those kinds of things until they've experienced one of those triggering events. So, you know, some things that we have seen happen in day-to-day work is death or illness of a business partner or even a spouse, which totally changes the business dynamic. Declining sales without a plan or maybe even the energy to turn that around, burnout and disillusionment, and then just a major life change. I would say retirement far and above is the reason most businesses that we list for sale are transitioning their business. But in those situations, those things that we've just described, the business owner is operating under pressure. Even if the business is sellable, there's less time to prepare, which is going to lead to fewer options, which is going to lead to less negotiating leverage. So, two quick contrast. In one case, we worked with the owner of a furniture manufacturing business who called us after losing a key employee and then realizing he didn't want to continue running the business either. But the financials weren't well organized. The business depended heavily on the owner and then this one key employee. So the buyer pool was much smaller. The sales process took much longer than he expected. And then the seller gets frustrated. And then to contrast that, in another situation, we worked with the owner of a pet boarding business who came into us 3 years before she planned to retire. We did that initial valuation, wasn't quite where she wanted it to be. So during that 3-year period of time, we were able to advise her on how to clean up the financials, document the systems and processes, which I'll add is far easier today in the days of AI than it used to be when you had to use a keyboard and your brain cells to type out whatever your policies and procedures were. It's far easier to document that today. We also talked to her about delegating the actual responsibilities to management. And that doesn't just mean on paper, that means true decision-making authority to the key players on the management team. And then how to assemble, like we've talked about, the right advisory team to start talking to someone like Jaret in terms of wealth management and working with her CPA and those kinds of things. So then when the business went to market, buyers are immediately able to recognize the strength and stability of that company. The owner had multiple offers and ultimately achieved a stronger valuation and better deal terms, contrasted to the example that I gave earlier. And then another example of a business that we were able to refer to Jaret. The owner came to us. The valuation was less than they hoped it would be. We referred that client to Jaret, who was able to work with adding some service lines, getting rid of some service lines, working his wife's role, declining that out of the business. And so the owner is going to spend the next year or so doing those things. He'll come back to us for a post valuation, and I'm sure it will come in higher than that pre-valuation. And then the other thing to think about, when we do a listing agreement with the seller, that's a 12-month listing agreement. So when we're talking about preparing the business for sale, that's prior to the time that we're actually going to be in the sales process. So again, that just reiterates the point that this process is longer than most owners think it is.
All right. So Jared, we have folks on the line, and we talked earlier about looking in the mirror. Starting with the business owner himself, what are financial, economic, personal issues that might be an indicator that they're exit ready?
Yeah, I think it looks different for everyone. There's definitely some consistencies, across whether it's business, financial, and the personal side. From the financial standpoint, I think the biggest indicator is that they have clarity, that they know where they actually stand. It's not on the back of a napkin, that they've actually gone through the process and are pretty confident that they know where they are. We can model out that transaction and see what it really looks like. That's an important milestone. I can't say it enough. And I think it doesn't guarantee readiness, but it definitely gives them a measurable framework and something they can work towards. Another indication is that they've addressed concentration risk. A lot of times we run across, owners that, have to sell their company for a ridiculous amount of money to be able to make things work, right? So they've done the things right over time, and then now they're in the driver's seat, right? And so they control the timing, they control, maybe it's not about the highest bidder, maybe it's about what's best for the employees, what's best for the company. Maybe they're able to factor in some of these other factors that may be important to them because they've addressed these other risks, the concentration risk, and they're exit ready, but it's on their time frame, right? So I think those are the consistencies that I would see.
So you're talking about the consistencies, things to look for on the personal side. You've talked a little bit about some of the things on the business side. Just as a side note, you've been doing this for a lot of years. does getting things right on one side seem to help them get things right on the other?
Yeah, I think it does. We mentioned the three legs of the stool earlier, and quite often when you talk about having an owner having their team in place, quite often you might have a different person that's focusing on each leg, right? So the personal side, maybe it's a different family member. The business side, maybe you've got somebody, a right hand that's really helping you drive that. I think, and then we've talked a lot about quarterbacking. We see ourselves in that role too, especially when it comes to this personal and financial plan. I want to talk a minute about what it looks like, what exit readiness can look like at the business side. And then lastly, just on the personal. So I think, when you come in and you see you've got a strong management team in place, the business is less dependent on the owner personally. And I know we've addressed that some. Like Mike said, you've got documented processes. You're buttoned up, you're packaged, and you're ready to go. We call that de-risking the business, and it's something you need to do right away. Look at having, either converting transactional revenue streams into recurring, or looking at developing recurring revenue streams. That's going to magnify your value and that best in class multiples that everybody's looking for. Getting contracts in place where there aren't, if you can, to kind of predict that revenue going forward, and show that you've got a little more structural integrity there in the sales, or in the on the top line of the revenue stream. And then you clean financial reporting. Can't say it enough. Get the books in order. And truthfully, there's a saying we have in EPI and the CEPA world, is that exit planning is business planning. This is how we all should be running our companies on the day to day. You're going to have more clarity into what's going on in the business, where the financials are, where the revenues are, where your costs are. You're going to run your business better and ultimately drive value. And so don't wait to the end to start running a great business. I'm going to say one last thing on the personal side. We talk a little bit about sometimes the readiness shows up and just being burnt out. You got health concerns, or you just need to exit the business for some reason. But a lot of times it's positive. You want to spend time with your family. Maybe you're going to explore another venture. The one thing I will stress, and we've even seen private equity, sophisticated buyers are interested in knowing what the owner's going to do after exit. And the reason they're interested in knowing that is because when you get right down to it, they're going to invest a significant amount of time and resources into the due diligence of a business and whether they're going to buy it or not. And when you get to the end and the owner, starts getting cold feet because he or she has no idea what they're going to do after the business and life after, it's not always about the dollars and cents. How are they going to spend their time? What's going to be their purpose? When too often the business has been their whole life. And so, some sophisticated buyers want to see the plan. What are you going to do for 365 days a year, 24 hours a day, 8 hours a day, 7 days a week? And being able to answer that in something other than I'm going to play golf, because that's a lot of golf, So just give it thought. And then just from a personal well-being and a mental health standpoint, I think that's something we don't talk about enough.
Well, thank you for those closing remarks. Jeannie, we're getting towards the end. You want to wrap things up for us?
Yeah, so I think the important point that we've all, tried to make today is prepare your business, allow enough time, and preparing the business doesn't necessarily mean you have to sell it. If you own a business, if you're even thinking about exiting in the next, say, 3 to 5 years, the most important thing you can do is just start the conversation early. Like, you don't have to make any decisions today, but beginning the discussion with experienced advisors is really going to allow you to understand what your business is worth, what buyers are looking for, and what steps might ultimately strengthen the company before going to market.
Mike, you have stuff to add to wrap it up?
Yeah, time creates a lot of options for people doing this early. It allows the owner to improve the financial reporting and reduce the dependency of them being the one that's running the day-to-day operations. Address all your tax concerns, all the financial retirement monies that you're going to need later on. I mean, get a wealth advisor, somebody that can help you do that. So that way, at the end of the day, the business is definitely going to look much better, and it's going to obviously, help the sale go a lot smoother with everybody involved. That way, when you exit the business, you get your transition period over, you can go out and enjoy what you want to enjoy in life, whether it's spending time with the grandkids or fishing on the water or whatever the case may be.
Well, Jared, any parting remarks?
Yeah, I'll emphasize the time. Build your team, get a team together. So that you're part of this. One of the success stories. Remember, only 25% or so of business transactions that go to market will transition successfully. So be a part of that 25%. Start early. Put a team together.
Thank you all. Jeannie, any final words to close it out?
No, I think that's it. We did have one question come in that I want to be sure that we address, which is how do you keep the sale of the business confidential so employees or competitors don't find out? And for that question, I will say that's huge. You really do not want employees and vendors and customers finding out that your business is for sale. And that's a risk that we see oftentimes with folks who think they can kind of do for sale by owner with their business. If you were trying to do that and you were listing your business for sale on one of the industry leading websites, you have to associate an email address, and then you're trying to screen potential buyers as they come in. We have non-disclosure agreements in place, and that's the first step for us before any conversations are had with any potential buyers. We also work with the seller when we're listing that business, and we will make that listing as blind and confidential as they want it to be. So for example, if it's a super niche business, we might just list that business for sale in the Commonwealth of Virginia. Some sellers don't mind if we said Roanoke, Virginia, or Lynchburg, Virginia, or maybe we just say the business is listed for sale in Southwest Virginia. So we will blind that listing to the comfort level of the seller. We also control the buyer screenings. Like I said, we are not going to waste the seller's time talking to buyers that are not ready, willing, and able to buy the business, because we know lenders are going to want to be sure that the resume is going to match up, that they can run the business, that they have the skill sets necessary to run the business. So a broker is going to take care of all of those things from a protective mechanism standpoint.
All right.
I think that's it. If anybody else has questions, feel free to email those. We'll be sure that you have contact information. But I just wanted to thank everyone who participated, Jaret and Rick, and those of you who logged in today. And like I said, we will be sending out a link to the recording of this webinar. So thanks, everybody.
Very good. Thank you. Enjoy the rest of your day.
Guys.
Yeah. Bye.